Hi, welcome to Yield on Cost Investing channel, a channel that educates dividend growth investors. In this current low interest rate environment, it has been difficult for retirees or income investors to generate enough yield off debt. But what if I told you that you'd be able to generate an income off stocks, and over time, this income would increase from 5 to up to 20% per year? Some of you might be wondering, what is all the fuss with dividends? I mean, most companies that pay dividends only pay a couple of percent per year. Even with a huge capital base of $1 million, for example, that is only $30,000 a year to live on, hardly capable of funding a person's living in retirement. Secondly, some people prefer no dividends at all because it allows a well-managed company to grow even faster by funding growth with retained earnings instead of issuing shares or borrowing money from the bank. However, the secret sauce behind dividends is not their current yield, but the rate the yield grows over time. Introducing yield on cost. Yield on cost is the rate of return of holding a stock based on the increase in yield from the time the stock was purchased until the end of the period measured. Long-term investors such as Warren Buffett have benefited greatly from yield on cost. Warren Buffett at the moment is getting a yield of approximately 66%. Yes, that's right, 66% from the original Coca-Cola shares he bought in the 1980s. You now might be wondering, well, how is yield on cost relevant to me? What if I don't have 30 years to wait to generate that kind of return? The good news is that you don't have to. I will present several screenshots of scenarios where compounding will seriously reduce the time needed to wait. The first scenario is where the dividend has a starting yield of 3.16%, and this yield grows at 20% per year after deducting inflation for 5 years, and then grows to 6% for the next 5 years. The blue coloured font is where the assumptions are entered, and the black coloured font is the formulas based on those assumptions. Yes, the first scenario is highly unrealistic, but it does demonstrate the power of compounding. Note, all scenarios, including this one, assume that all dividends are reinvested and not spent. The second scenario represents a small cap stock which has made it big and become the main player in the industry they operate in. These figures are far more realistic, and you would probably at least be able to find some comparable examples. The final scenario represents a well-known blue-chip company which has been beaten down because of a recession or temporary bad news which has sent the stock price tumbling. This dividend play is basically money for jam. A well-known blue-chip brand stock price has almost halved. This in turn means you can get an impressive yield of 90% over an 11-year period because you had the foresight of buying during a market crash instead of panicking and selling. At Yield on Cost Investing, we aim to educate, entertain, and help our viewers be better dividend growth investors by giving them the knowledge to think independently so they can become better long-term investors and ultimately succeed in the difficult world that is investing. Please like and subscribe for future videos, and stay tuned for the next video.